As of February 27, 2026, the 10-year U.S. Treasury yield touched 3.9998%, its lowest level in 3 months since last November, and has fallen nearly 30 basis points this month. Despite generally strong U.S. inflation and employment data and fading expectations for Federal Reserve rate cuts, a surge in risk aversion and a pullback in equities have become the primary drivers of bond market strength and lower yields, breaking the recent pattern where data dictated market moves. In terms of price action, the 10-year yield fell roughly 4.5 basis points on the day, decisively breaking below the closely watched 4.0% level. Starting the month around 4.30%, yields have trended steadily lower, accumulating a decline of nearly 30 basis points, with about 9 basis points of that coming this week alone. Meanwhile, U.S. stocks weakened, with the S&P 500 falling 0.54% overnight and the Nasdaq dropping 1.18%. Spreading AI anxiety and tech sector weakness triggered a clear rotation out of equities and into defensive assets like Treasuries, creating a pronounced stock-bond correlation effect. The break below 4.0% reflects a confluence of 3 key factors, with the surge in risk aversion as the primary catalyst. On the geopolitical front, differences between the U.S. and Iran remain unresolved ahead of technical talks scheduled for March 2nd, and persistent uncertainty in the Middle East continues to fuel safe haven demand, driving capital into treasuries. On policy risk, after the Supreme Court struck down Trump's earlier emergency tariffs, he quickly unveiled new measures, a policy whiplash that has heightened market anxiety and further bolstered Treasury's appeal. Meanwhile, anxiety triggered by viral articles about AI continues to spread. Fears that AI could dent corporate profits are pressuring tech, delivery, and payment stocks, accelerating the shift into safe assets. The equity pullback also provided sustained buying support for bonds. Following NVIDIA's earnings release, market frenzy over the AI sector intensified, and the retreat in AI-related names dragged the S&P 500 and Nasdaq lower. The stock-bond seesaw effect was on full display, with capital flowing from volatile equities into stable treasuries, a key force behind the bond rally. Some experts note that falling stocks have been a crucial support for treasuries recently. With risk-off sentiment in the driver's seat, funds keep rotating back into bonds, pushing yields back toward lower levels. Softer economic fundamentals also added a layer of resilience. The advance reading of Q4 U.S. GDP came in at 1.4%, the lowest since Q1 2025, reinforcing expectations of a slowdown and supporting demand for bonds. Additionally, initial jobless claims came in at 212,000, below the 215,000 consensus, signaling marginal softening in the labor market, a development that further strengthened the case for bond allocation and contributed to the yield decline. In summary, the 10-year Treasury yield's drop below 4.0% is the product of 3 converging forces: risk aversion, the equity sell-off, and economic softness, rather than being driven by rate cut expectations. In the near term, the 4.0% level may represent a temporary floor. Looking ahead, markets will need to closely track developments in U.S.-Iran tensions and the rollout of Trump's tariff policies, volatility in AI-related stocks, and the depth of the equity pullback, and how incoming inflation and jobs data repricing expectations for Fed policy. These factors will ultimately dictate the direction of Treasury yields from here.